Your next guest says that it is indeed oil that may be the most important part of the stock market right now. Let's bring in Mark Avalone. He is president of Potomac Wealth Advisors. Mark, good to have you on again this morning. Why is oil so important to equities right now?
Good morning, Brian. And it's important because it's a bit of a wild card, and it's hard to play out where this goes. You just spent a couple of days at that oil conference, and you heard firsthand how murky the future is, and it so much depends on this Ukraine conflict, which outcome is murky and unknown. So therefore, you can't plan for it. Just when we think the Fed might try to get inflation under control, prices are at their pump going up 10, 20, 30 cents a gallon per day. So that trickles through other areas of the economy. It impacts the industrial area. It impacts manufacturing. It impacts consumers' pockets, their ability to spend. It impacts confidence. And it's going to impact the inflation numbers. So across the board, oil has to get under control in order for us to have a sustained rally and not just one-day wonders like we had yesterday.
Is it more that, to your point, the consumer gets crushed, they just don't have any excess money to add to corporate earnings? Or is it that the Fed believes it's got to become more aggressive? Or is it some sort of combination of the both? And I ask about the Fed, Mark, not because they're not important, they are, but there is nothing the Federal Reserve can likely do to bring down the price of oil other than nudging this economy into a recession.
Well, that's a lot there, and none of that is really a good outcome. And stagflation is really the word you didn't use, and that's the big worry, right? The big worry is we have inflation. It's oil driven, it's supply chain driven, and the Fed is powerless in both of those areas. Look, if we have a glimmer of good news on inflation, it was in that chart that you showed earlier. Last February and March, we were still in a low inflation world. The inflation spiked up April and May. Inflation is a year-over-year phenomenon. Come May, the comparables for the prior year for inflation are going to be very hard to have in this very elevated range. So we're going to see moderating inflation. Even if there's a spike in oil, the pressure on inflation will be coming down because on a year-over-year basis, the baseline for inflation is going to be much higher, and hence the hurdle rate for current year inflation is going to be even higher. So I think that's what investors could actually take some comfort in. I think the headline number on inflation, ex energy, is going to start to look better in a month or two.
Okay. Well, let's hope. And listen, right now, the markets are having a tough start to the year. If you're not invested in oil and gas, you're probably down on the year. But if you go back a couple of years and you've ridden the market, you're up. You've still made a lot of money in the last few years. So you're kind of sitting on these gains, watching the market nervously, wondering what to do. Is it time to sell some stocks you made money in and maybe pick up some things that are down now 20 or 30% in the last couple of months and maybe go for more hard assets or things like real estate or banks? What do we do, Mark?
Well, you mentioned real estate, but unfortunately, real estate's starting to correlate to the stock market pretty well, depending on certain areas, of course. But generally, it's getting harder to find less diversified assets when you see these melt-ups or the meltdowns. I think investors should look to the scenario I'm laying out in the second half of this year, where inflation moderates and growth slows. And in a slowing growth world, investors want growth stocks. That's what happened in the period from 2009 to 2017, where we had slow economic growth and growth outperformed value, tech stocks soared. And these massive cash flowing machines, the mega cap tech names, you talked about Amazon earlier, companies with strong franchise value, reliable cash flow sources, and high top line growth are going to become in vogue when the Fed, higher oil prices, and this whole economy starts to slow down out of this hyper growth mode. And that's where we would be looking. We would actually be going right into technology and growth right now.